This is my bulletproof risk management plan that's helped me secure over 6 figures in funded withdrawals. Now, this is something that you should only be doing if you're trading funded capital. This is really the only way to guarantee payouts and do it very, very easily. And this is really how I manage my capital. So I've got nearly 2 million in funded capital. So let's just put that figure on the screen. So you've got 2 million like that. Now this is bunched into smaller funded accounts, as I say, like a 200K, 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 and so on. As you see, you can get where I'm going with this. We can start off with an example like this, and this is exactly what I'm doing. When I'm taking a trade, no matter how good the trade is, a good trader thinks in losses and never in wins, never think in wins, because every trade you have the exact same chance to either win or lose. So really what we're looking at is that because funded capital is actually demo funds, this is why it's actually an absolute game changer for anyone that's trading prop firm capital, because I can take a trade on my first 200K as long as I didn't bunch them all together, and I could lose this trade. So I'm minus 1% because I've risked 1%. On this one, I take a loss. I'm also down 1%. So minus 1, minus 1. But because I diversified, this account's down minus 1 and this one's down minus 1 instead of trading all of them, and all of them are down now minus 2. So now what I can do, if I take the third trade, hypothetically, this one was a win. So this one is up 2% because we're going for 2 risk to reward. So despite losing 2 trades in a row, the third one has already guaranteed a $4,000 payout because 2 risk to reward, 1% risk. I'm making $4,000 despite losing 2,000 here and 2,000 here. Now, the funny thing about this is if I bunched them all together, I'd actually still be in a loss right now, because I would just be getting out of drawdown. But because this is demo funds, the funny thing is you only make a payout when the money's real. This is why people have a skewed mind about prop firms. Why would you not trade this when your money's not even on the line? It's fake. It's only real when you make the money. If you are losing, you don't pay the money back. You only paid for the challenge. So this is the fastest way for someone to actually consistently acquire funded payouts. So we'll put on the screen, in the last 5 months, since February, I've done $36,000 with FTMO, $35,000 with Alpha Capital Group. So add them two together, that's $70,000 since February with just 2 funded accounts. So with just 2 prop firms, I managed to acquire $70,000 in just the last 5 months. If you add the other funded accounts, then we're pushing way over 6 figures. Now, one thing that you should keep in mind is that if you were to do this on a live account, it would not work the same. Because if you think about it, on a live account, if you're to go minus 1, and then obviously plus 2, you're just break even. So you should really be taking advantage of prop firms whilst you have the chance, because this is only possible when you're diversifying all your different prop firm accounts. So even with the example that I had last week, this is a real example of how I managed my funds last week. I actually lost 2 trades last week and I won 1 trade last week, but I still ended up making 2 payouts. And that's because I didn't bunch all of my funded accounts together. I traded them separately. So on one of my funded accounts, I was already up around $6,000, right? But I lost the trade, which was $1,000. So it took me to $5,000. So that's the first trade. I took a loss on this. I bunched it with 1 more funded account. On that funded account, I lost $2,000 because that was a 200K, so 1%. Now, on my next trade, I ended up winning the trade, but I took it on a fresh funded account. That one jumped straight into $3,500 of profit. That's why even though if I ever have a negative week, I'm still going to be profitable and I'm still going to make funded payouts. But when I have a really good week, instead of still managing my risk on the bad weeks, I'm going to have a super profitable week where I could be making like $13,000, $15,000, $17,000 from one successful trade. Because you just have to understand risk. If you are a bad trader, you will be thinking about putting all of your eggs in one basket, trading all my funded accounts together. But that's very, very dumb. Think like a hedge fund. What is a hedge fund doing? They have low risk strategy, medium risk strategy, and high risk strategy. The low risk strategy, we're looking at going into very low risk assets like S&P. With the medium risk, maybe gold. High risk is always trading, because the trader is the one that's the risk manager. That's your job. You are in control of the funds. Don't think about what's a good decision for me, what's a good decision for the fund. And that is every single time that you go into a trade, you have to have the exact same thought process. Even if the trades always look the same, even if they always look good, you still need to be thinking, what if this loses? Because it always has every chance of doing so. That is the thing with my model. I'm a swing trader, but I have an intraday model. I can't put the same importance on both of these because swings, if you just think about the math, the swing, there's a lot less frequency in the market. I might get in the market once a week, maybe once every 2 weeks. Whereas with the intraday model, I have the chance, and this is just math and logic, because there's more candlesticks on an intraday time frame, like the 15-minute, 5-minute. There are way more opportunities mathematically that I could enter a trade on the intraday. So risk has to be lower. That's how this works. If I'm getting a trade once a week on the swing model, I could potentially risk 2%. Whereas the intraday, I should never risk more than 1% because the frequency is higher. So if you just do the math and you look at the win rate of the swing model is naturally going to be much higher. And that is because there's a lot more room for error. The stop loss is way bigger, so I can manage it easier. If the fundamentals don't go my way, I can actually think about cutting risk at some point. I could go to break even at some point. I could scale in at some point. With intraday, a human can only make a few emotional decisions per day. So if I'm getting chopped on an intraday position, I don't want to have to, okay, it's all happening so fast. The 5-minute time frame's moving, it's expanding. Price is choppy, news is coming out in 5 minutes. I'm just a human at the end of the day. So no matter what these traders say, you do have to understand yourself as a trader and you have to do what works best for you. So after 5 years of trading, I've understood that if I am trading my intraday model, it should have less exposure than the swing model because of the way that the math plays out, because of the way it makes me feel. And a trader should also be thinking about the relapse that it might give you emotionally. Because if I make a bad decision on any week, I should be thinking how this is going to affect me in the next trade or next week. So if I do something stupid with the intraday model, I go risk 3% because I want to make a 50K payout. That, if I lose, is going to affect me next week because now I'm trying to make that back. So never make a decision that is going to affect you for the next week, for the next trade. So really, this risk management plan is the reason that I've really been able to stay consistent on bad weeks, master the markets on any sort of expansion week, news week. This is very, very easy to do. The only thing it requires is a brain. So if you have a brain, you would be doing this because it's actually very stupid to do anything else. It's fake money. It's only real when you make profit. Diversify and let the payouts come to you. So I'm going to put some payouts on the screen. This one, this one, this one, this one, this one, and that one as well. So as you can see, this definitely works. You do need to think like a hedge fund. Think, believe in the market. Don't believe in yourself. The market is always right. And if you want to see more of this, follow my Instagram and you'll see all the payouts that I post on a weekly basis. If you enjoyed this video, make sure to subscribe to the YouTube channel. I really want to make a lot more of these educational videos because I know it actually helps people. There's no point posting stuff that's not going to help anyone. If this video helped you, make sure to subscribe, leave a like, and watch the next few videos because you're going to learn a lot.